The mission of this journey is to help people that are considering a move to the real estate industry, have been doing this for a short period of time, or who simply want to know more about real estate and the behind the scenes ins and outs of the highs and sometimes lows of this industry. Welcome to Real Estate Simplified.
Yeah. Hey everybody, Brandon Kaler here again with Real Estate Simplified. We have an exciting episode today. We're going to be talking about loans, mortgages, maybe some misconceptions or myths about loans, or how much you need for down payment. There's a lot of people out there that they've got a saying called beans and rice and beans, and sometimes we get this mindset of, well, I have to have 20% down, or my parents always said that they put 15% down or 25% down. So we're gonna get into that. But first, my guest today, Melissa Condensa with Guild Mortgage. So thank you for hanging out with me to do this episode. And just really quick, if you could tell everybody where you work, what you do, and then we'll go from there.
Absolutely. So my name is Melissa Condensa. I work for Guild Mortgage, which is a mortgage banker, meaning that we lend our own money. We service our own loans as well. So if we make a loan, the payments come to us. And all we do are loans. So we have no choice but to do them very well.
Yeah. When you do one thing, you better make sure you do it right.
Yeah, for sure. And we actually won the J.D. Power Award for customer service.
Oh, very cool.
So we are doing it right.
Yeah.
I'm going to keep trying to do that. But we do all kinds of loans, conventional, FHA, VA, USDA, jumbo, non-conforming, and I know we'll get into some of those details, but we do
right after this introduction. We're just going to get right into it.
Okay, and I'm a producing branch manager, which means I manage a branch and also do loans directly with consumers.
Awesome. So you kind of threw out some of the different loan types or some loan options. If you don't mind, go through maybe some of the most common loans that you're seeing and that you're servicing, and then maybe even some. I work with investors, and there's kind of been some that you throw out a 203K, or it's like, okay, what does that mean? Yeah, like, let's figure that thing out. So kind of some of the most common ones, and maybe some where it's like, I haven't really heard of that.
Sure. So mortgages, it's one of those things where on the face of it, it's kind of boring. It's a loan, but there's usually nothing boring about it.
Yeah.
Because it's like a puzzle to solve for each person. Now, some people are going to just fit into the conventional puzzle, which is going to be a loan with anywhere from 3% down to 20% down. With any loan, if you don't put 20% down, you're going to be paying mortgage insurance.
Right.
Well, any FHA, VA, USDA, conventional. So with the conventional loan, that mortgage insurance is provided by a private company. The private company prices to risk. Risk is mostly defined by the credit score. So someone with a high credit score is going to pay very little for that mortgage insurance, and that's why a conventional loan is going to be a really good option for them.
So talk a little bit about those amounts, because our first home, FHA, 2015. I'm the only person working in our home. My wife's going to chiropractic school, making a lot less than what I would like to be making.
Right.
And credit score was okay, but hey, you still get slapped with the PMI because it's the 3.5 down or the 5% down. I think ours varied from I think it was about $100 a month. Is that common, or could it be even higher than that?
So with FHA, good segue into that. FHA is a loan where the mortgage insurance is provided by the government. It's technically a government guarantee.
Okay.
That program gives everybody the same mortgage insurance rate. It's 0.85.
Gotcha.
So with a conventional loan with a 5% down, it could be as low as 0.2. So,
wow. Okay.
Or with a lower credit score on a conventional loan, it could be 2.5.
Wow.
So there's a huge swing there. But with FHA, it's always 0.85.
Okay.
And FHA is just a great program for first-time home buyers because it is low down payment.
Right.
It will allow somebody to stretch their debt to income ratio a little bit farther than a conventional loan would. So it will allow somebody where maybe there's only one person working in the family, or one person has a W-2 job, the other person has a self-employed job.
Right.
isn't yet reporting income on the tax returns, which is important.
Yeah.
So
in order to get approved for loans, they like to
it is.
see that you're making some money. Yeah.
Exactly, and report to the government that you're making some money.
Yeah.
But in that case, we'd be able to stretch the debt ratio up to about 56% to get someone into a home. We know there's more income coming into the home.
Right.
It's just not qualifying income.
Gotcha.
So FHA is a great option for someone like that. And then they'll also go down to lower credit scores.
Okay.
We'll go down to 580 with with 3.5% down.
Okay.
And actually, we'll go down to a 540 credit score if someone could.
I think I saw. Did you? I think you might have sent an update saying like, "Hey, that threshold had changed."
I think
recently, maybe in the last couple months.
It was fairly recent.
Okay. Yeah, because I remember typically that number is that 580, and then it recently dropped a little bit.
And there are definitely people that fall into that bucket. I mean, you see someone who wants to sell their current home, has a lot of equity in it, maybe has a 540 credit score, but they can put 10 or 15% down or 20% down, and we can get them approved. And close.
Yeah,
Which is, of course,
and close on time.
On time.
Yeah,
yes.
most important. So we've talked about conventional, we've talked about FHA. Maybe what are some of the other options?
So the other two, I would say most common would be, one would be VA. So that's going to be the Veterans Administration Loan. That's going to be eligible for service members who have served, who are active duty, or have retired, or the spouses of deceased service members.
Oh, okay.
So that is a great program. It's a great benefit that I think any veteran that's eligible for the program should at least look at.
Right.
Unless they're putting 20% down, it probably is the option that makes sense, because they do pay a guarantee fee, which is sort of equivalent to an upfront mortgage insurance premium.
Oh, okay.
But it's financed into the loan, and there's no monthly mortgage insurance.
Wow.
So they would have the lowest payment on any given loan amount if they're putting less than 20% down.
Gotcha.
Because there's no mortgage insurance, monthly mortgage insurance payment there.
Wow. Okay. And you would still be putting less than 20% down.
Yeah. So that can be 0 down.
Wow.
No down payment at all. And then
perks of being somebody that served and does serve in the military.
Exactly.
Really
so
cool.
I love that program. It's also very forgiving in terms of credit scores. We can go down to 580 or 540 on that one too.
Okay.
Debt ratio is also very flexible. I would put it equivalent with FHA.
Yeah.
Just the limitation is you have to have served in the military to use it.
Right.
So not everybody can
Yeah.
use it.
I always will kind of, at least in my head, not get it confused, but it's like, okay, a VA, no, you actually had to have served, or somebody or your spouse served, and it's not like USAA.
No,
like
exactly.
I think of USAA, I'm like, oh yeah, my cousin served, so now I qualified. It's like, no, it's a little bit different.
Right.
Yeah. So I always kind of throw that around in my head.
If you have a deceased spouse that served, that does count.
Gotcha. Okay.
So that's a good one. The other one that I would say is fairly common is USDA. That's also going to be 100% financing.
Okay.
It's going to be a little bit more restrictive in a couple of different ways. One is location. So it's offered, it's a rural it's a agricultural program.
Okay.
So USDA. You have to be in an area that's still considered rural, and that would be, it's based on the census numbers. I haven't seen it change based on the last one.
Right.
So areas, Oak Point still qualifies.
Okay.
I think parts of Prosper might.
Oh, wow.
Of Salina.
Okay.
It does also have, and then out to the east, it's going to be out east of Rockwall.
Okay. Like Heath.
South, I think so.
If you're not in Texas,
that
you have no clue
sense.
what these cities are. But this is a good point of reference for people that are
for
here.
the Metroplex.
Yes.
And then to the south, kind of Red Oak, and outside of there, Waxahachie is populated enough that it does not count, but the area around it does.
Okay.
And then out on the eastern side, I'm actually not totally sure, but it has to be kind of rural, so it's going to be a little bit of a commute for some people depending on where they work. It does also have income limits, so that's the only one of these 4 programs that does have income restrictions. So there's a maximum amount of income someone can make to qualify.
Would that be net or gross?
That is total household income. So it is including, like, if let's say grandma lives with you and she gets Social Security, that has to be counted in.
Oh wow.
So it's a more difficult program to work with.
Right.
But if someone can qualify and is looking in that area, it's a great option because
Yeah.
it is no down, and the mortgage insurance is 0.35. So
Could you?
it's low.
Yeah, that's extremely low.
Mhm.
But you said 0.35. So could somebody purchase land with a USDA loan, or does it have to have a primary single family residence?
It has to have a house on it.
Okay, there you go. Yeah, all right.
Yeah, and so for any of the loans that a normal mortgage lender would do, there
Mhm.
does need to be a house.
Gotcha.
Now, it can be single family, it can be manufactured, it can be log cabin, as long as there are comparable sales.
Yeah.
It
What about a
can be
tiny home?
Tiny homes, yes.
Okay, there we go.
As long as there are comparable sales.
Got it. Okay.
The
Yeah.
one that I tried to finance, well, one, I think it was the only one I tried to finance, there were no comparable sales.
Ah.
So we ended up not being able to finance it.
That's a
But
bummer.
yeah, so condos, townhouses, any of those can be
All
financed.
fair game. Yeah.
Yes. Now
Okay.
I will say FHA and FHA and VA are gonna have some restrictions on condominiums.
Okay.
And there probably aren't any in USDA eligible areas.
Yeah.
But
Yeah. Okay. All right. So we talked about those three. What about, I had mentioned like the 203K, or
Yeah.
what about non-primary, or maybe mortgages where you want to lump renovations in, or it's an investment property or something. Kind of
okay,
those two
are fun.
options. Yeah.
Okay, so the renovation loan, that's available FHA and conventional.
Okay.
And I think that's it's a product that I think should get more attention. And
Yeah.
I think one of the reasons is that inventory is very scarce. Like,
It's terrifying.
can someone
Yes,
sell their house,
actually.
please, please.
Yeah.
So with,
I'm not too proud. I will get on my knees and beg
Yeah.
people at this point sometimes.
sell
Yeah.
your house.
Yeah.
The 2.5% rates we
It's
put
not-
people in last year.
Yeah, they're
don't
gone.
Cause.
Yeah.
So.
Yeah.
But okay, so let's say you're looking for a house. You've got someone looking for a house. They might want to consider the houses that aren't already beautiful.
Mhm.
Aren't
That
already,
don't check all 10 of their boxes? Yes.
Exactly. Not yet HGTV ready. But this loan program allows you to go into a house that, let's say, hasn't been updated, that's in a great neighborhood, that
Okay.
if you updated it would be worth more.
Right.
It takes the after improved value, and your appraisal gets based on that, and your loan gets based on that.
Okay.
So you get to roll in all of the cost of renovation as long as it's supported by the after improved value of
Gotcha.
the appraisal.
Is there a threshold on how much dollar amount that you can invest into the
No, not.
the renovation? Okay.
No, if you're doing, there is a streamlined 203K that's an FHA product
Okay.
where it's kind of easier to do.
Gotcha.
That is limited to 35,000 and no structural repairs.
Okay.
But the full 203K, which is the FHA option, and then the home style
Right.
renovation, which is the Fannie Mae option, you can do anything.
Sky's the limit.
Yeah, you can
Okay.
put in a pool if you're doing the conventional one. You can put in a workshop. You can.
Now, would anybody
foundation
ever be,
repair.
I guess, quote unquote, upside down?
No, they're not
Okay.
gonna let you get upside down
Okay.
because that's where the loan gets based on the after improved value based on the appraisal.
Praised about. Okay.
So the key to making this loan work is if you know you want to do it,
Right.
you want to have your contractor picked out.
Yes.
So that your contractor can go out
And have a
to-
competent realtor
Yes.
who's running comps
Exactly.
for you.
And a
Okay.
loan officer who knows what they're
Shameless
doing.
plug. Yeah. All right. You see
and,
what we're doing?
And I've been in this business for 22 years.
Yeah.
So well, I don't do these loans. I have someone that I refer them to at
Okay.
Guild who's on the renovation team.
Yeah.
They're just specialized enough that we want somebody who really knows what they're doing handling these.
Sure.
And so Tina handles them for me, and we get them closed easily. It's not a big deal. No
Love it.
stress because she does them all day long.
Right.
So I think it's a great option, and it's something that I would never steer someone away from.
Right.
I've done one myself when I bought
Yeah,
one
okay.
because I kind of wanted to see what it was like, and I bought a house that was really ugly and needed a lot of updates. So-
Need some love. Need some
Yeah.
attention. Yeah.
So I just think that needs to be at least considered, and I think as
Oh
an
my
agent,
gosh,
if you
yes.
have that in the back of your head, that you
Absolutely.
know you could show them this house that has a lot of upside potential,
Yeah.
and they can roll in the cost. I just think it's a great option.
Yeah. I'm thinking about one or two potential clients right now that, they're kind of like, oh, well, we're willing to pay a little bit less, or, get a home that needs a little bit of love.
Yeah.
And it's, well,
Well, and you
let's
can get
talk
some
about a
deals on
203K.
those homes. I
Oh,
mean,
for sure. Yeah.
even just the wrong paint
With
colors.
wrong paint color, or you know, it's a 1975 build and it hasn't been updated since 1975. And the flooring, you're like, wow, this is great.
If you're in a museum.
And yes.
Yeah.
So I love that because I don't feel like that's talked about enough.
I don't think it is either. You might need a 45-day contract instead of 30. 30 might be tough, but not impossible.
Yeah.
But you don't need a 60-day.
Right, okay. So, I mean, it's still, you're talking about a month and a half, and you're gonna get this thing down. So, but do the renovations need to be completed before the close?
No.
Okay.
No.
So talk about that, because when I think about the appraisal, right? You need to have that appraisal in order to get the loan amount,
right?
And then be able to close. But in my mind, I would think, well, the renovations need to be done prior to. Okay.
So the appraisal gets done just based on the contractor's bid. So the contractor gives a very detailed bid of what's going to be done and then how much will it cost.
Gotcha.
And then the appraiser takes that and basically, it's kind of like an appraisal on a new construction home that's not finished.
Okay.
So it's like, this is subject to all of this.
Right.
Finished.
Everything being done. Yeah. Okay.
Yeah.
Very cool. All right. Love 203K.
Yeah, it's
so
fun.
really, I wish I knew about it when I bought my home.
Right. That loan program can also be used on investment properties. So if you got investors that are looking to buy and hold,
right?
Say, or even flip, it could be used for that.
What's the interest rate difference?
It's maybe eighth to a quarter higher.
Okay.
Tiny bit higher.
And then down payment requirement, is that going to be higher?
No different.
Okay, so you could do a conventional for the same
5%.
5%.
Yeah, 5%, FHA 3.5.
There we go.
Yeah.
All right, 203Ks. That's all I'm going to be talking about for the next 6 months, especially in this market where it's
you just need
it's a challenge to find homes at a certain price point and not pay $25,000 or $50,000 over list price.
Yeah. So I just think that is great. Now for investors, another option is you can get a little creative to help investors buy homes. The debt service coverage ratio loan. So that would allow an investor to come in, qualify for the loan just based on the fact that their payment is going to be lower than the income they expect to make from the property. Okay. And that basically we don't document anything. Particularly good for self-employed investors. Okay. Or people who get basically all of their money from rental properties. Right. They could work for them too.
So is that just solely based on comps? Rental comps in the area?
Yep. That's exactly right.
Okay.
Yeah.
Gotcha. Huh. Okay. So and remind me, what was that one called?
That's a debt service coverage ratio loan.
Debt service. I'm gonna have to ask you
DSCR.
again. Yeah.
What's that loan for investors?
I'll just text you whenever it comes up. It's like, I'm gonna need you to type this sucker out because I don't remember it all.
We have that. Other sort of creative things. We do have a bank statement loan option available for self-employed borrowers. So if you've got somebody that just doesn't report enough to the IRS, right, doesn't mean they can't get a loan.
Yeah.
Does mean it's going to be a little bit more expensive.
Right.
So usually with those clients, I'll go through and say, okay, here's what this loan option looks like. Here's the interest rate. Here's how much income you would need to report to the IRS to qualify for a regular loan. Go chat with your CPA and see which one pencils out to be the better option.
Always consult your CPA.
Yes.
Yeah. And that's a great point because my wife and I were starting to work with an estate planner, and our businesses make a certain amount of money, but we give ourselves a certain salary based on the average the average salary for a chiropractor nationally, or the average for a realtor nationally. So that is interesting where it's like you're going to need to be at this level so your interest rate isn't higher, or you qualify for a certain amount.
And as a self-employed person, you have some flexibility in how much you claim in expenses.
Yes, very much.
As W-2 people, we don't have that.
It's true. Yeah, it's pretty much on the books.
Yeah, we get sad when it comes to tax season.
Yeah. So definitely. Okay, so
I forgot a loan program.
Yeah.
Jumbo.
Okay, I was thinking of that one and didn't say it, but yes.
So jumbo loans are going to be anything over $647,200.
Okay.
So that is going to throw it into a jumbo loan. So it's non-conforming. It's a loan limit above, or a loan above the conventional loan limit.
Okay.
The thing I would say as far as the benefit is you get to do a higher loan amount.
Right.
The downside is it is like when you think of underwriting as they are scrutinizing every single thing, that's a jumbo loan.
Okay, fun.
So yes, and it's every bank state, every line on every bank statement. They ask for so much more documentation. That would
just
be,
solely because of the amount that they're issuing out.
It's because of the amount, and it's also because Fannie and Freddie aren't ultimately buying the loan.
Okay.
So it's being held on the balance sheet of a bank.
Sure. Okay.
Or
okay.
a entity that is providing the.
They've got more
funds for
skin in
the
the
loan.
game.
They do, yes.
Got
And it's a big loan.
Oh yeah. Hearing 647, 200,
Yeah.
I'm like, oh my god.
So
Okay.
I think we'll go up to 2 or 3 million. I'm not quite sure.
Wow. Okay.
But you're gonna need 10% down minimum.
Wow.
And 20% down gets you much better rates with those options. But
Okay.
those are options too. And then you can also look at ways to avoid those loans by doing first and second combos. So
That would be like multiple loans?
yeah, so you do a first lien for the 647,
Okay.
and then a second lien. Like you could do a $500,000 second lien.
Whew.
I know. But again, that's something that we look at all options for people
Right.
and just pencil out which one makes the most sense.
Yeah.
Like some people get bonuses regularly, and if they're
Sure.
gonna get a $100,000 bonus every year and they wanna just throw it at the second lien and have it paid off in a couple of years,
Yeah.
then that option is gonna make more sense. If that's not their situation, the jumbo loan might make more sense.
Right.
So,
Okay. All right.
Yeah,
So I think we've covered all the fun ones, or maybe the most common
I
ones.
think so.
So we've thrown around interest rates
Yes.
a little bit. We've talked about that, and I know, and you know much more about this than I do, because this is kind of what you talk about every single day,
Yes.
and something that I try to talk with clients
Yeah.
with on as often of a basis as I can, because interest rates are going up.
They
So
are.
can you
Yes.
kind of talk about that, and maybe the reasons why they're going up, or
Yes.
trends that we're seeing for 2022 and beyond?
Okay, so rates are going up because they were held at artificially low levels for
Right.
the last 2 years by the Federal Reserve,
Mm-hmm.
mainly because they were buying mortgage-backed securities. And it was something that they could do to keep this segment of the economy going and
Right.
humming along, and they did.
Yeah.
I can attest to that. They
Yeah.
definitely did.
Well,
so
and
it
the
worked.
refinances
The
in the last 2
refinances were
years were
crazy,
insane.
Yeah, so it worked, but now that the economy, so they put a threshold for employment numbers and then inflation numbers.
Okay.
Well, we hit the inflation number a little while ago.
Yeah.
We're good there.
Yes.
We hit the
Yeah, it can stop now.
Just stop it. We hit the employment number last month.
Okay, so that's the amount of
3.9%
people.
employment.
Okay,
Yeah, so that's back to full employment is what that's considered.
gotcha. Under 4%.
Yes.
Okay.
So they're like, okay, we don't have to do this anymore, basically. So
Yeah.
now, and they had an announcement today.
We helped you guys out long
Yeah.
enough. It's time.
You're
Let's
good.
go. Yeah.
Let's go back to normal economic forces.
Right.
And if you think about it, no investor in their right mind is going to want to buy a 30-year debt at 2.5. Like it just
Sure.
doesn't make sense.
Right.
That's a bad use of your money.
Yeah.
Even when inflation's at 3.
Yeah.
So we're at 7. So they have to come up. Like there's just no way.
Right.
Now we're at 3.625, 3.75 for
Okay.
most deals today.
For a 30-year fix.
For a 30-year fixed.
Okay.
Very low 3s, maybe high 2s for a 15.
Okay.
Today.
Yes.
That was a key word. Thank you for
Yeah.
saying that. So the projection is they'll probably be about 4, maybe a little above 4 by the end of the year. So they're going to keep going
Okay.
up. But still, that's super low.
Yeah.
Historical
Well, and if you think
standards.
about historically,
Yes.
that's still super low.
It's not, and if people want to buy a home, they're probably gonna buy a home.
Right.
Now, could they get to a point where some people are gonna be priced out of the market?
Yep.
Yes, I think property taxes are probably a bigger issue there than
Sure.
interest rates, but
Well,
that's-
yeah, especially with equity increasing,
Yeah.
property taxes are going to go
tax
up.
rates and- So
Mhm.
that's, but the thing that I think is important about interest rates is if people are shopping, I think the most important 2 things to know are you gotta shop on the same day. So if
Mhm.
you're looking at different lenders, you've gotta get all the rates on the same day.
Right.
Preferably within the same hour.
Yeah.
Because we, like today,
Because it'll change daily.
it could, and it could change during the day. Like we could have a morning
Mm.
rate sheet and an afternoon rate sheet.
Yeah.
So, and I saw this in the last few weeks where people
Mm.
had a quote from before New Year and then after, and they're like, what?
What happened? It
Oh
was
my gosh.
2.8.
Right. I'm like, when did you get that? Oh yeah, in December. Okay.
Yeah,
No,
yeah.
Call them back. They don't have it anymore.
Right.
So that's important. And then the other thing is make sure they know that how many discount points are being charged.
Mm.
Most rates get quoted with a point.
Yeah.
But a lot of people don't disclose that.
Sure.
They'll just say, and if you look at Quicken's website, I'm gonna pick on them for a second.
Yeah.
Because
That's okay. I was
they
knocking
put
on
it
Dave
on there.
Ramsey earlier, so it's totally we're just calling out everybody today.
If you look at their website, it says here's today's rate. And then there's fine print. If you click on the fine print,
Mhm.
it says with 2 points. So you have to know how many discount points
Right.
are being quoted.
So you're not
at
really
that
getting
rate.
a 2.5
Exactly.
in February of 2020.
Right. And then APR is a tool that is designed to help make that clear.
Mm-hmm.
So APR is a reflection of the total cost of credit. So it's the interest rate plus the discount points plus other lender fees.
Okay.
So ideally, if you can look at those two numbers side by side, it will tell you. Because,
Gotcha.
and then the other thing is, no matter which lender you choose, someone chooses, the title fee, the insurance, the taxes, they're all gonna be the same.
Right.
Doesn't matter how low loan officer one projects they will be.
Right.
They're gonna be what they're gonna be.
Yeah.
And my philosophy is, let's give someone a number that at the end was hopefully a little bit higher than what they're gonna end up with.
For sure.
Because
Overshoot it a
otherwise,
little bit,
yeah, you don't,
rather than you're showing up to the closing table and you're like,
You're
why am
like,
I paying extra?
Why is my payment $500 higher?
Yeah.
Oh, because your taxes that I quoted you initially were completely wrong.
Yeah.
So,
Like, that's not great for the customer experience standpoint.
no, it just isn't. And I think, especially first-time home buyers, they need to go into this experience feeling confident and feeling like they're getting the full information.
Yeah.
So transparency is important.
Yes.
It's sometimes hard to get, unfortunately.
Yeah. Well,
And if it's too good to be true, if it sounds too good to be true, it
probably is.
Yeah.
Yeah. Or at least consult.
Yes.
Shop around a little bit, or consult your
Yeah.
realtor or somebody in your family that does loans in
Yeah.
California. You're
Yeah.
like, hey, is this right?
Yeah.
Because I mean, at the end of the day, it's still sales, and some
is.
people might not be as transparent as they really should be.
Yeah, and you want to be happy at closing.
Yes, yeah. What I think about too is like, I need referrals
Yes.
from these people too. So this isn't a
Exactly.
one and done deal,
No.
because they have a really great experience. They can refer 5 people to me or 10 people to me, rather than,
Exactly.
okay, I gotta start with a brand new pond
Right.
every single
time.
day. Yeah,
Yeah.
because I burned bridges with them. So it's kind of a question that I struggle with at times, and you probably do as well, when it's the hesitation,
Yes.
or
Yes.
you know what, we're gonna wait another couple months, or well, we're not entirely sure if my husband's still gonna be or my wife's still gonna be in the same job, so we're gonna wait until summer. Like, what would be the
then
one
it's next
thing?
summer.
Yeah,
It's
and
next summer,
and they're still renting, or
Yeah.
they're in their home and now they're priced out,
And they've lost so much equity.
and they've lost so much
Rates are
equity,
higher.
or like, hey, our budget was $650, and
Yeah.
we're looking in Frisco, and now I'm like, what are you gonna find for $650
Right.
when you wanted a 4-bed 3-bath for 2,800 square feet? Like,
Yeah,
it's not there
it
anymore.
doesn't exist anymore.
So
Yeah.
what are kind of some of those words of encouragement that you would have for a buyer?
I have no idea why lenders are so scary.
Yeah.
But
I don't think you're scary,
I don't
but
think I'm scary. But I think it's the uncertainty, and
Sure.
it's knowing that you're going to come face to face with your credit score.
oh yeah,
And
I love
you're
when I have
gonna-
buyers that are hesitant. They're like, don't run the score just yet.
Yeah.
Why?
Okay, so no, let's bust that myth first. Pulling credit is going to take 2 to 5 points off their mortgage score.
Right.
That's it.
Yeah. If it's
And-
bad, it's already bad.
Right. And if it's
That 2
bad,
points isn't going to change anything.
no. And if it's bad, and if I know it's bad, I can help you get it better.
Right.
If I don't know it's bad, then I can't help you.
Right.
And if you go to Credit Karma and use their credit simulator, which is an awesome tool,
Mhm.
love it, but that is not it's not solving for the mortgage score, it's solving for the consumer score.
Sure.
It's solving for the credit card scores. So I had someone ask me this today, what credit simulator would you recommend I go to? None.
Right. Come to
Just
me.
Do the application.
Yeah.
I will run you through it. If
Right.
it's not something I can help you with, I will help give you direction with. I will pass you off to somebody who can.
For sure.
And let's get you if you aren't ready now, let's get you to the point where you are ready.
Right.
And
let's pause, let's take
Yeah.
6 months or whatever it might be, and
you
then you're
might
ready to
be
go.
100% ready right now and just not know it. And
Yeah.
you might be scared of what the numbers might be. Well, let's figure out what they really are.
Mm-hmm.
And maybe you don't like this payment. Well, maybe this is the payment you like. Here's what that looks like in terms of buying power.
Right.
Now, go out with Brandon and look at those homes, and you might decide you really do want to be in the higher bracket.
Yeah.
And you qualify for it. So let's just
Yeah.
work through this home buying process, budget, and the rest of it, and get to a point where they're comfortable. But I just, if they want to buy a house, they should look into what it really looks like.
Right.
And just, I mean, if they don't qualify now, I'm going to help them get to the point
Sure.
where they qualify. And I think that's, I mean, there probably are lenders out there that will just go, oh, you don't qualify. Bye.
Yeah. Come back, I guess, whenever your score's
Yeah.
better. You know?
No direction.
Yeah.
I do know that happens, and that is probably ultimately why they're afraid, but that is not something that I would ever do.
Yeah.
And I want to get them to where they can buy a house if they want to buy a house.
Absolutely. Yeah. Well, and stop renting.
Yes,
Right. And start building
yes.
some equity.
Yeah.
And start investing in yourself.
And that's the other thing, that if someone's hesitant about buying because of the cost of it, I will help, like, I'll go through a scenario to show them what they're paying in rent, how that compares to the interest that they'll be paying versus the principal that they're
Right.
paying, how much appreciation they can expect to get over the next 5 years or 10 years or however long they
Especially
think they
right
will
now,
have.
it's insane.
Oh.
Yeah.
And if they think, oh, this isn't going to continue, well, okay, let's set it at 2%. We can set it at 3%.
Yeah.
We can like whatever you think the rate of appreciation is going to be.
Yeah.
We'll set it at. We'll plug that number in, and we'll look at where that gets you.
I-
It's still better than renting.
Still, it's 100% better than renting, because rental costs right now is insane
It is.
too.
It is.
I mean, we're planning on putting our home for rent.
Yeah.
You know, being landlords for the first time, that'll be
That's
fun.
exciting.
Having tenants. But it's like, you know, looking at the comps, we could probably list it for like $2,000
Yeah.
in Grand Prairie, Texas, and it just blows my mind that
Right.
what if I'm paying $2,000? I mean, that's $24,000 a year
I know.
that I'm getting
Yeah,
because I'm
exactly.
the landlord, because I own the property. But you're willing to spend $24,000 that you're never going to get back.
Right.
That's
You get a place to live, but you
Yeah.
don't get anything else. You're helping to pay Brandon's mortgage.
yeah. Thank you.
And yeah.
Because the mortgage is far less than that $2,000 I'm charging you.
Right. Right.
Okay, so the last question I have is around just the future, because one thing that I also get a common question from
Mhm.
potential buyers, you know, before we write up the contract,
Yeah.
is, well, is the market gonna crash, or, you know, like, well, we're buying this house for $300,000. What if the market crashes and we're upside down? And I know what I
Yes.
say,
Yeah.
but you know, I'd like to get somebody else maybe saying the same thing or something similar.
Yeah.
To like, hey, you know, let's not Chicken Little this thing.
No, let's definitely not. So my thought on that is a couple things. There are two major things that are impacting it here particularly. So DFW might not be representative of the whole country.
Sure.
But we have people moving here every single day for jobs. We have companies
Yes.
moving their headquarters here, setting up satellite operations here. So that influx of additional new residents is going to keep pushing the home prices up.
Right.
So until that stops,
Well, and what are the states that they're coming from too?
right,
You know,
It's-
California or New York or New Jersey or Colorado, where home
prices are
prices
way
are
higher.
way higher.
People have money to spend,
Mhm.
and so and eventually, I think, what's going to happen is you're going to see higher density, and
Yeah.
it's not. People are moving here.
Right.
We're going to keep having pressure on the home prices.
Absolutely.
So that's one, and then the other thing is just demographics.
Mm-hmm.
So we have the highest number of people that turned, I think, either 30 or 30 this
Okay.
year. So 29 to 34 is the most likely age that people will buy their first home.
Yeah, young
So you've got-
professionals, they're starting to save up the money,
Yep.
maybe starting a family.
So you've got like 3 more years of these people cycling through and
Yeah.
buying their first homes, and that's just added pressure to the people moving here that are, we're gonna see a lot of appreciation,
Right.
even if rates go up
Yeah.
for the next several years. I think most critically for the next 3 or 4. After that, it'll just be more normal in-migration, but
Yeah.
people are still moving here.
People are
It's a
still
great
moving
place
here.
to live.
Prices are still going
And,
up. I
yeah.
mean, I ran comps on, so you did the loan for my mom,
Yeah,
and list price, I'll just kind of like, not fully full disclosure, but kind of in this general area of pricing, went in at list price. The appraisal came in 30,000 below.
Right.
And we ended up getting it under contract or renegotiating, doing an amendment for that to get it at the appraised price. And ran comps because she's already thinking about moving again, which is great.
Yeah.
So the comps came back and it's like 70 more.
Wow.
In, what was it,
Like,
15 months?
yeah.
Maybe 15 months?
Yeah.
So, you know, to your point of like, home prices are going to continue to increase because people are coming and people are paying. So yeah, I'm glad our messaging is consistent.
Okay,
yes,
good.
because it's very much.
Yeah.
I mean, there's plenty of times I'll run the comps and I'm like, guys, you've already made $50,000 in your home and you've been here for 6 months or 9 months, whatever.
The other thing that I think people had in the back of their head was that there'd be this wave of foreclosures coming after the pandemic.
Yeah.
And the industry, the mortgage industry, I think learned from the last meltdown.
Yeah.
And did things very differently this time. They allowed forbearance plans for people.
Yes.
And
I think they extended them
payments.
as well.
I think they're finally now over them. But people, if they couldn't make a payment, they didn't have to make a payment. And the missed payments were added to the back of the loan. So when they sell the house, they're gonna have to pay them back, but it puts them in a position where they can stay in their house. There is no threat of foreclosure for that.
Okay.
I mean, there could be just the normal cause of ordinary business, but
now if they do that,
it.
if they do that, do they have to catch up?
No.
Okay. So you miss a payment and it's like, hey, it's basically a 30-year plus 1 month?
Yes, exactly.
Okay, got it.
So they had to get into the forbearance plan and, but yeah, I mean, they could have missed many months and it's all just added.
Just pushed to the back.
Mm-hmm.
Okay, got it.
So pay back eventually. But
Great for homeowners.
It
And they're
is.
still building equity.
Yes, exactly.
At the same time.
Exactly.
So that's really cool. I know we've kind of talked about down payments for some of those, but this will actually be my last question. I realize that I hadn't talked about this, and I think it is a really important topic because a lot of people are, I have to do 20% down.
Yeah. Yes. Yeah.
I have to do 20% down. There's no way, Dave Ramsey told me so. I'm like,
No.
well, okay, yes, and you're just delaying building equity. You're delaying.
Exactly. And you're, in the meantime, building someone else's equity with your rent payment, unless you're living with your mom and dad.
Yes.
So.
Yeah.
Don't wait.
Pros and cons of that. So,
we could get into that. But yeah, don't wait because, and especially if you have good credit, let's say you're a Dave Ramsey fan and you have almost no credit debt, which is admirable to a point.
Yeah.
Have a credit card, use it, pay it off every month.
Right.
Would be my modified Dave Ramsey version.
Yes.
Then your scores will be really high. Then your mortgage insurance is going to be next to nothing.
Right.
And if you penciled out, and I'd be happy to do this with anybody, what it would look like to buy now with 3% versus wait until you can save 20% and look at how much missed equity you've got, how much you would have paid in rent during that time.
Yeah.
I think most people would just vomit.
Oh, for sure.
And go out and buy a house.
Yeah. Well,
It's
and
just
you know
awful.
what? They could, in building that equity in 6 months or 12 months, their loan to value ratio is probably going to be past that 80-20 threshold.
Yes.
Potentially,
Yeah.
not always. And then if they wanted to even cash out refi and go purchase an investment property or whatever, right? Like there's really creative, unique ways to build wealth rather than being like,
yes. Wait till you have
I gotta wait.
No, don't
Uncle
wait.
Dave said so. So I guess high level like FHA.
I think Dave says wait till you can pay cash, doesn't he?
He
Maybe.
I used to be
Can't.
I used to be a believer, and like it started to affect my marriage. So that's where I was like, well, okay, like we can go out to
You
eat.
shifted a little.
Yeah, we can eat some steak every now and then. So yes, slight shifts.
But yeah, I think, and especially with rates where they are right now, I mean, let's get out and take advantage of it.
Yeah.
Leverage the relatively inexpensive cost of money and
Absolutely.
purchase an appreciating asset.
Yes, an appreciating asset. Yes. So FHA, 3.5.
Yep.
Conventional, 5%.
3%.
3%. Okay. See, I'm getting schooled today as well. USDA potentially zero, or
Yep,
it is zero. VA zero. Jumbo
10.
Okay, 10%.
Yep.
And then what about investment or secondary homes?
Second homes is 10% down.
Okay.
Investment is going to be 15.
Okay.
Better rates though with 20 or 25% down.
Gotcha.
And I'm throwing one other interesting thing.
Okay.
And that is if somebody wants to purchase a home for a parent, an elderly parent,
Yeah.
cannot afford to do it on their own, you can buy a second owner-occupied home with 5% down.
Oh, very cool.
Let's say you wanted to buy your mom a house down the street.
She can afford it. She's fine.
Let's pretend she could.
Got it. Okay, hypotheticals.
So hypotheticals. You could buy her a house with it would be a second owner-occupied home for you with a 5% down payment and owner-occupied rates.
Okay.
So just a really
That's like some honor
great
system
way.
stuff too.
It,
Right.
yeah,
Okay.
there are some checks that get, I mean, some things get checked out,
Okay, got
but just a great way to help your family out if
Oh my
you
gosh,
can,
yes. Yeah.
and allow your family to hopefully move in close by and
Yeah.
be a part of
Help
that
nanny and
exactly.
yeah, hang out with the grandkids and all that good
Exactly.
stuff.
So,
All right. Well, thank you so much for
Absolutely.
the information on loans as well as down payments and interest rates and the sky is not falling.
No, it is not.
It's gonna continue to stay right where it is, and home
Yep.
prices are gonna continue to increase. And if you buy your home now, you're gonna look back in a year or 2 years and
Be very happy
count
you did.
that as a very large blessing.
Yeah.
So thank you for your time. And yeah, if y'all have any questions about mortgages or interest rates or anything like that, or being able to talk yourself off the ledge, you can reach out to Melissa. What's kind of the best way for people to get a hold of you?
So my website's melissacondensa.com. Of
Okay.
course, Cadenza is not the easiest name, but it's
There have been harder ones, yes.
That's true. So you can also find me on YouTube. I've got some frequently asked questions that are answered there, and most of them very, very, very short, minute
Okay.
or less. But I think those are the two best ways to connect, and you can connect with me via email, and phone numbers are all on there.
Alrighty,
So
very cool.
yeah, thank you for having me.
Yes,
It was fun.
absolutely. All right.